think one of the great advantages of technical analysis is you can think, as I mentioned, you can think in multiple timeframes. So a lot of times when you're getting really excited about big moves, you're looking way too short term. And unfortunately, the modern financial world draws you into the flickering ticks of what's happening moment to moment, right? So one big down day, it's a disaster. One big up day, it's the next big thing.
Yeah.
So what we do is look at a lot more weekly charts and say, look, has the secular picture really shifted on this name or not?
This podcast is for advisor use only and not to be distributed to the public. The Wealth Consulting Group is an SEC registered investment advisor, and the opinions voiced and contents in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful.
Welcome to another episode of The Bull of Wall Street. I'm Jim Worden, Chief Investment Officer for the Wealth Consulting Group. I'm joined by my co-host, Talley Leger, our Chief Market Strategist. And we are honored and thrilled to have David Keller with us. Dave is the President and Chief Strategist of Sierra Alpha Research. And Dave, I just have to say right off the bat, I always do research on our guests, and I run this through AI, and it says the best way to think about Dave is technical analyst, behavioral psychologist, visual thinker, teacher, musician, and pilot.
I love that.
I love that. And then it said that combination is genuinely unusual. I love it. I think it's great. So we're thrilled to have you, Dave. I know you worked years ago. You worked in the chart room.
Yeah.
I had an experience years ago to go through it. And this is before I got my CMT and before I really got into technical analysis, but I was so fascinated. And I remember one of my friends that worked at Fidelity, who was a wholesaler at the time, he was saying, Jim, all these portfolio managers, they don't talk about technical analysis, but behind closed doors, they're all technicians.
We used to joke that there would be chart porn in people's desks. They'd sort of, sheepishly pull out the drawer and there would be charts in there. But Fidelity, honestly, culturally was unique and still is, I think, in that technical analysis is more broadly accepted than in a lot of buy-side firms of that size and stature. I think that was one of the things that really attracted me to the firm. And one of the things that I enjoyed the most of my time there was the fact that portfolio managers were definitely generally, open to thinking about charts, and they recognized the mistakes that would be made if they didn't pay closer attention to the charts. And I think that was a painful lesson a lot of them would learn early in their careers and then would make corrective moves after that.
It's interesting. I mean, I feel like if you went back in time, it wasn't always, technical analysis hasn't always been very well received for whatever reason. I feel like there's more people realizing that this is a real tool, that it really works, it really helps. But any thoughts you have on that?
Many, Jim. Two things come to mind, right? So I would say one thing that has changed is the rise in the hedge fund community, right? Which, I started in the industry in June of 2000. And, just from that period to now, over 26 years, you've seen how, hedge fund activity has become, sort of a side feature of the financial industry to, in a lot of ways, a central, part of the industry and a growing part of the industry. A lot of people, going into the, hedge fund arena, came from non-traditional backgrounds. So it was sort of a changing of the guard in terms of how you think about things. But stuff like price momentum and talking about trend following, these are words that are more modern ways of describing things that I would argue technical analysts have been doing for decades, if not centuries, which is you watch prices and you can see what the crowd is doing. So I love that there is language and now evidence to support the fact that prices trend and there's value in that, and that, following price momentum can lead to superior returns. I think that's good. So I think hedge funds were part of that, and some successful hedge funds that are trend followers. The other thing would be the rise in behavioral finance. A couple Nobel Prizes going to behavioral economists didn't hurt in terms of legitimizing the fact that investors are largely irrational, sort of popularizing the idea that people don't always make perfect decisions with their money, which again, I think anecdotally any trader would know from the moment you start trading. But now that there's academic research to sort of support, look, investors are irrational and this is why things are inefficient. That sort of validates why charts, I think, should add value. So I think for the technical analysis community, you're right. I think, decades ago, they were sort of the pariahs of the industry. And the CMT Association started because those technical analysts didn't have a place to get together with other analysts. And now, again, I think it's a very different environment. I think that's healthy.
Interesting. Talley, jump in here.
Oh, yeah. Well, Dave, as you know, we got a lot in common with the musical studies and background. I'm more of a macro guy, but I've always had a very healthy appreciation for technicals. So this is great. I mean, I could just listen to you for the whole segment, but I got to get some words in here a little bit. But we did a switcheroo, man. So I was in your shoes over a decade ago. I mean, you're running Sierra Alpha now. You're independent, but so was I. I was running Macrovision Research when you were at Fidelity.
I remember.
And it was very flattering to me because you used to vote for me back in the day. And so
for sure.
You were a client. Now I guess we're clients, right?
The tables have shifted. No, and to be honest with you, I mean, one of the things that was really cool about being at a large institution at the time was you would get a ton of research. But one of the worst things about being at an institution like that was you had a fire hose of research coming at you. Mm-hmm. So for us, it was always, how do you filter through the noise of just stuff to try to find actual thoughtful content that challenged your thinking? And you always struck me as one that would do that. So yeah, if there's, I mean, I don't regret a lot of things about leaving Fidelity, but one thing I do miss was having access to people like you sharing awesome ideas. That was a real cool part of it.
Well, I guess the moral of the story is, be nice and make friends, because you go on both sides of the business like this. So it's a
good way to go through life.
Yeah. But I wanted to ask you, because we're kind of in one of these, and I don't want to lead the witness too much, but one of these points in time or stages of the market and macro cycle where the technicals are saying different things than the fundamentals. And so remember, our audience, they're advisors. So how would you help them? And I want you to say it your way. How would you help them I guess reconcile is really the best word for it. The positive fundamentals and the deteriorating technicals. Is it price simply gets ahead of the earnings, or should we make that leap of faith and really focus on the outlook for the fundamentals like sales and margins?
So many directions to go to answer that question.
Yeah.
That's a really thoughtful one. So a couple thoughts here, right? So number one, I would say the fundamentals and the technicals are not necessarily in disagreement everywhere, just in certain parts of the market, right? And I would say what we would always say with that, stocks eventually trade to their fundamental valuations, but the technicals often lead the fundamentals, right? An efficient markets hypothesis would tell you new information is out there, a stock immediately goes to its new kind of theoretical value. I think most investors, most advisors would know in practice that absolutely does not happen, right? There's a path that goes from point A to point B. So, the CMT Association talks about how technical analysis allows you to navigate that gap between where we're at right now and where we probably should be based on earnings growth and expectations for future earnings growth. So I would say if you're thinking of the AI trade, which is a, general catch-all for a lot of different types of companies at this point at different parts of that AI life cycle. But some of those names have, I think without argument, have gotten way over their skis in terms of an aggressive euphoric rise. And you saw SanDisk log exponential gains and now has, sort of registered exponential losses just in the last month, right? From June to July. We've seen names like Micron and SanDisk shed a lot of that value. And so I would say the charts can help you to recognize where we're at within that path. And having an idea of what these companies have the potential to do is an important part of that. I don't think you skip that as an essential part of the process, but you also have to recognize that investors get way too excited and they get way too desperate. They also get way too negative and pessimistic. Mm-hmm. And so charts help you recognize when we're a little overvalued or undervalued based on where we probably should be. And so so that's one way to think of it. The second way to think of it is in multiple timeframes, right? So part of the technical analysis toolkit is designed to help us understand that tactical timeframe, right? That swing trading timeframe, which is really more about mean reversion, right? The fact that stocks are based on trader sentiment and whether people are overshooting or undershooting where it probably should be at any given moment. And there are these little wiggles and squiggles that we can use to analyze and identify short-term swings. But on a longer-term time frame, it's more about trend following. It's more about momentum. And for me, that means it's more about relative strength. It's more about evaluating how stocks or ETFs are performing relative to others. So I think a lot of investors get into trouble when they think the game is, I want to try to predict the future really well. I think the game is, I want to have my eyes and ears open and recognize when those shifts are happening. And we're seeing a pretty big shift in technology, right? Away from sort of the hyperscalers, away from a lot of the chip makers, now into some of the software names that arguably are going to be able to reinvent themselves using AI. And I think the charts and particularly relative strength show you that rotation from one theme to the next. So I would argue that fundamental and technical analysis very much complementary when used correctly. That's the challenge.
So I've got a follow up on that. I mean, we try to use the toolkits. Tally does a great job bringing the macro toolkit, and we have a fundamental toolkit and technical analysis, and then there's some quant or quantum mental that incorporates technicals. When you look at some of these names, Dave, that are in a drawdown, but their rise has been meteoric, right? It's been parabolic. Where do you kind of draw the line? Because in some cases, I look at these things, they look broken.
Yeah.
And some of it is very clear that they're broken. Some software names just technically look broken. Some of them go back to that. They look like it's a mean reversion, still good trend. This is a buy point, right? I mean, how do you look at that? How do you look at those? I'm just curious because I feel, even within the technical community, some people say it's a sell. Others will say, the fundamentals are still good. This is oversold.
Yep. So it's so a couple comments there. So number one, I would say one of the exercises we would do at Fidelity that was pretty successful. We would call it the thrice blessed screen, or the trip aces. And it was when the fundamental, technical, and quantitative teams all agreed that it was a good idea. And so the fundamental group would be looking at the management team, the debt, the earnings, et cetera. The technical team would be looking at the trends, the momentum, the sentiment. The quantitative team would be modeling, let's look at companies in previous cycles that have done really well and let's find similar characteristics. And when we would all agree, that basket of stocks often did the best. And I think the reason is because they're not mutually exclusive, right? You can have a good company that is not a good stock. And so when the chart goes down, that doesn't mean necessarily that SanDisk isn't going to be a great company 5 years from now. Like, that's not my job to try to figure that out. But I don't think the fact that the chart's down 30, 40% doesn't mean it's not a great long-term idea. So I think, so that's one way to think of it, right? Is recognize that the charts are telling you how we're navigating from this point right now to AI being an absolutely transformational technology over the next 5 to 10 years. But I would say, even if you get the theme right, you get paid for it if you have the right bets on. And that was something we would talk a lot about at Fidelity, right? Do you want to be right, or do you want to make money? That's a Ned Davis quote that we would often throw around, right? So I think, if your job is to identify the right bets to make, I think charts are so valuable because that tells you, is this the right time to be putting in a position now that it's going to set me up for success for a longer period of time. So that's one way to think about it. The second thing is, I think one of the great advantages of technical analysis is you can think, as I mentioned, you can think in multiple timeframes. So a lot of times when you're getting really excited about big moves, you're looking way too short term. And unfortunately, the modern financial world draws you into the flickering ticks of what's happening moment to moment, right? So one big down day, it's a disaster. One big up day, it's the next big thing.
Yeah.
So I do, what we do is look at a lot more weekly charts and say, look, has the secular picture really shifted on this name or not? And you will find with certain ideas and certain ETFs, there's a clear rotation from a period of distribution to a period of accumulation. On some larger themes, there's a period of accumulation switching into distribution. And so I think, when in doubt, zoom out. If the short term is noisy, take a big step back from the monitor and bring in more data and really think about what has materially changed. And I would say in some of those semiconductor names, it certainly feels like we're in a period of distribution where instead of holding key support levels, which is what a healthy bull market looks like, we're failing to hold key moving averages, right? Levels where you would expect dip buyers to come in, it's not happening. And so I think when those dip buyers don't come in, one of my mentors, Ralph Acampora, told me, all right, that means something's different and there's no more willing buyers. And unfortunately, I think that's what you're seeing in a lot of those previous leadership names here.
Oh, that's good. That makes a lot of sense. And I feel like it's kind of the weight of the evidence.
Let me chime in on a related point there. So Jim and I, we have, if you think of the Venn diagram, we've got those three main buckets. It's the fundamentals, the macro, and the technicals, and they all work together. It's a multidisciplinary kind of approach or process. But in your experience, Dave, how do you get advisors to think about investing coherently like that as opposed to separate disciplines? You know what I mean?
Yeah. So, that's a really good point. And I think the Venn diagram's a good paradigm. I usually think of it as a stool. So I think of 4 pillars in the stool: fundamental, technical, macroeconomic, and behavioral. So fundamental is, what are these companies doing? Are they able to grow earnings, and are the expectations improving, right? EPS revisions are usually an important factor there. The technical, strong trends, strong momentum, strong breadth. The macroeconomic, and I think there's, macro themes to be thinking about: events in the Middle East, midterm elections, obviously a lot of things to think about, interest rate environment. But I would say from a technical, approach, the broad indexes, large cap versus small cap, styles, and growth versus value. These are all kind of broader technical themes that help us understand leadership rotation. And then the fourth pillar for me is, or the fourth pillar of the leg of the stool, is behavioral, which is what happens between our ears. And I think that's where advisors probably have a great opportunity in their own approach to investing and leaning more on systematic, disciplined review of the evidence, but also helping their clients, because clients generally have trouble with the emotional impact of investment decisions and putting money at risk. And I think that's probably one of the great benefits of having an advisor, is that you have someone that can help you navigate things and say, yeah, this kind of thing has happened before and we've gotten through it, and here's how. And I always tell people that if one of those legs of the stools come off, you're probably still okay, but it's a little tentative. But if you lose 2 of those, you're not going to be sitting very long. And so we want to make sure that we have each of those pretty stable. And I often find for a lot of investors, 1 or 2 of those are pretty well defined, and 1 or 2 of those are probably underdeveloped. And those underdeveloped pillars are where that's where you have an opportunity to learn. That's where you have an opportunity to lean on resources, experts that have seen some of these things before. And that's where you have an opportunity to grow as an investor. And I think for advisors and for their clients, that's probably a great way to think about it.
That's
when you say behavioral, that kind of got me thinking about just, the Uber driver, giving stock tips, or people being, afraid and need to get out. I mean, we talk to advisors all the time. Our ultimate goal is making life better and helping our clients and our advisors. What do you think are the biggest mistakes from a behavioral standpoint that we all make? I mean, there's professionals that, there's emotional biases and cognitive errors that we can make, but advisors can make those and clients can make those. And what do you think the biggest thing is to change that and kind of improve that situation?
Yeah, so it's a really thoughtful question, and I would say I've worked with investors that are individual investors running very small portfolios up to institutions running hundreds of billions of dollars. And if it's any comfort for wherever you're at in that spectrum, is everyone makes behavioral mistakes. I've actually lectured on behavioral finance at a number of colleges and universities, and I still am fall victim to those behavioral challenges. So you're not immune, unfortunately, but there is hope. And so I think, if you're familiar with like a 12-step program, I think there's a reason why the first step is to admit you have a problem. I think for a lot of investors, there's this resistance to, accepting the fact that they're imperfect and that they're going to make mistakes. And I think one of the things I've learned is that successful investors are humble and that they recognize their weaknesses, and they've found ways to benefit from their strengths, and they've surrounded themselves with resources and techniques to address their weaknesses. And I would say from a behavioral perspective, to directly answer your question, Jim, there are a couple that come to mind. The two that I think are most poignant are confirmation bias is by far the most common one. And the confirmation bias is essentially we make our decision first, and then we start gathering evidence, right? So we decide we're bullish on Bitcoin, we're bearish on semiconductors, we're bullish on small caps. Then we start reading and listening and watching, and any evidence that supports our thesis, we kind of mentally give it more value, and anything that disagrees, we kind of mentally push it away. And what we've done by gathering evidence is simply raise conviction on something we were already going to do, but we don't really open ourselves up to the idea that we might not have had the right thesis. So what I encourage investors to do is reverse that, right? And start with the evidence. Have a consistent routine of gathering evidence. What's the weight of the evidence, as you said, Jim? What is it telling me about the current market conditions? How am I positioned relative to the evidence? If those aren't in alignment, then I need to start changing some positioning. So we want to gather the evidence first and then make decisions. And I call that an evidence-based investment process as opposed to an emotion-based investment process. So confirmation bias is number one. The second one, which is I think very powerful, especially right about now, is called the endowment bias or the endowment effect. This is where essentially you develop an emotional attachment to a holding. And it's not a financial thing. This is something that's actually prevalent in other parts of our lives as humans. But you develop an emotional attachment to a particular position. It does well for you, so you're probably feeling good about it. But then when the evidence shifts and all of a sudden it's no longer a good stock, all of a sudden the earnings are not where you think they should be, all of a sudden the chart is starting to look bad, we still hold on to that position because of our emotional attachment to that. And I'm sure advisors listening or watching have seen that with clients, particularly with long-term holdings. They're a Coke shareholder, right? This name or whatever it is, like that's kind of their thing. And you have to recognize that when the evidence shifts and it's no longer helping us achieve our goals, then we have to have the courage and the conviction to make a change. So the way that you address both of those, I would argue, is by having consistency in your processes and how you gather evidence. If you're just kind of one-off randomly doing things, you're going to get random results, and you're going to be much more open to being the victim of a behavioral bias like those two.
That's super helpful. I think that makes a lot of sense. Go for it, Talley.
Yeah, I mean, there's so much in the technical silo. It's such a rich and kind of broad and diverse discipline, as you both well know. You've got price, you've got breadth, you've got sentiment. I think behavioral has a toe or a finger in there as well. But I wanted to ask you about sentiment in particular right here, because I think the answer, I mean, you get 10 technicians in the room, you probably get 10 different answers. But what camp are you in now? Are you seeing excessive bullishness or bearishness in this environment?
Yeah. Oh, that's a really good question. And this is one of those times, Tally, where I would say that the macro and maybe the micro are differing in some ways, right? And I think a big part of that is the fact that our benchmarks are so overweight the growth play. 40% of the benchmarks technology. If you think of the S&P 500, if you add the other kind of technology-ish things in other sectors, that's probably about 50% of the benchmark. So we are dominated by growth stocks. And so those are the areas of the market that have been struggling mightily here over the last 4 to 6 weeks. As a result, the indexes at the index level, it feels very heavy. It feels very toppy, right? So if you ask someone, how does the market feel? I mean, an experienced market practitioner looks at the chart and goes, feels toppy because we were going up really aggressively in April and May. Now we're kind of going sideways, right? And so I guess the way I would think of it is I always think of the broader market trend very simplistically as we are going up, we're going down, or we're going sideways, right? So we're in a period of accumulation where dip buyers are buying, short-term weakness. We're in a distribution phase where investors are taking any rally as an opportunity to sell more. We're in a consolidation phase, which is a sideways kind of pretty clear range. And I think the S&P is very clearly in that third bucket. We're in a period where you don't really see big accumulation. You don't really see the indexes breaking out, but we really don't see a ton of distribution. So on the macro level, I would say we're really more consolidating. But at the micro level, you're seeing exaggerated accumulation, right? So the equal weighted S&P made a new all-time high this week. Breadth indicators, the advanced decline lines, made new all-time highs in July. So even though the indexes are flat, there are plenty of stocks that still look remarkably strong. And it's in non-growthy sectors, right? It's been in industrials, it's been in financials, it's been in some materials, it's been in some healthcare. I mean, there are charts that are making new 52-week highs right now. It's just not in the names that had been making new 52-week highs before. On the same token, I would say there are plenty of charts that have been remarkably strong that are all breaking down. And it's, the Mag 7 names, which are, air quotes around magnificent at this point, because they're less and less really showing those signs of strength. There's a lot of distribution in semiconductors. So what's happening is a lot of things are starting to work. A lot of things are not working. So at the macro level, I would say the picture is pretty mixed. It's pretty neutral. But what I would also say is when the benchmarks are neutral and then there are a lot of stocks that are still working, great opportunity for active managers, great opportunity to lean into what's working. And for me, relative strength is by far the best way to focus on there. I look for charts that are starting to outperform the S&P. Because one thing I learned at Fidelity, right? If you want to outperform the S&P 500, you need to own things that are outperforming the S&P 500. It's pretty straightforward. So if we can continue to rotate away from what's not working and rotate into what is, I think we have an opportunity to outperform it. So I think this is a really good environment, despite the fact that it feels very toppy at the index level. Does that make sense?
Yeah, no, I would agree with that assessment. And I have, it sounds like a similar kind of mosaic approach. So giving everything a fair shake, and what's the balance of evidence, sentiments, pretty neutral right here. But again, I force myself to go through that exercise to avoid cherry picking the data, because on one side you could point to and isolate the AAII survey. There's more bears than bulls right now, and there's a mountain of cash when you look at the ICI money market mutual fund balances. But on the other side, you've got elevated margin debt that's kind of ringing the alarm bell. And you've also got, heading into this risk reversal, you had the professional money managers that were fully invested, so all these different signals. So it's great to kind of ask another practitioner what they're seeing. So thank you.
Yeah, especially on the sentiment side, I think to your point, it's been very mixed, to be honest with you. And the AAII survey, which is one I refer to regularly, right? So that's individual investors. It's been very volatile, right? So that series has actually been flipping around quite a bit. And we haven't necessarily gotten to huge extremes, which are often big warning signs, right? Like over 50% or 60% bullishness. We haven't gotten up to that level, but just from one week to the next, we've been chopping around quite a bit. The name exposure index is another one that I look, which is active investment managers. Same thing. It's kind of been, pretty volatile and flopping around there. So, again, I feel like on the macro side, it's kind of netting out to a wait and see, right? It's sort of and to be honest, I feel like it's sort of a sit on your hands moment to wait to see how this market evolves from here. Because I think there are a lot of scenarios that could play out, certainly in the weeks and the months to come. Yeah.
Dave, do you think that could actually be a good thing in some ways? Like the market kind of taking a breather. It's building a base, and then we can kind of, go high. I personally like to see markets that kind of do that from time to time, rather than just straight up, and then there's not really any areas of support when things do get bad.
Yeah. So two things to think about, right? So number one, remember that markets can correct in two ways, right? They can correct in price or they can correct in time, right? So
Mhm.
a price correction is what we normally think of, which is there's a big move,
Sure.
all of a sudden there's a big drawdown, and we're seeing that in some stocks for sure, but that's what we traditionally think of. And that's all about a sudden reversal and just thinking about how far we need to come down before it's tempting to get back in and nibble a bit. But a time correction also happens quite often, and that's really what we're in right now, right? We're just sort of pausing. It's sort of like the digestion phase after the big Thanksgiving dinner, and you're just kind of digesting it,
Yeah.
and it's not clear at that point whether we resolve to the upside or not. And so I think from a technical perspective, it's helpful to sort of lay out a structure, right? So the S&P has kind of been between like 7,300, 7,600. S&P breaks out above 7,600. There's renewed leadership. I think that's a pretty strong argument
Yeah.
for playing the long side and following that momentum higher, right? Which would mean we'd have to resolve a lot of these kind of consolidation, congestion issues we've been in. But also, I think there's a scenario where we break down below 7,300. We start to break moving average support, and things all
Mm.
of a sudden look very ugly very quickly. And it's not hard to imagine the macro forces that would create that sort of
Mm.
environment. And unfortunately, between the Fed meeting this week, between the events in the Middle East, like our cup runneth over of things that could go wrong for the market here.
Yeah.
But again, I think that's where the charts can be really helpful because we'll see the signs of distribution usually before it gets too late to to make adjustments for it. So I would think of this, it's really more of a time correction than anything. And so now it's looking for signs that we have a re-exertion of new leadership. That's the key here.
Dave, when you're looking at price, because you mentioned that, and breadth, and you mentioned that one too, and they disagree, which trust more, and what do you see right now? What's going on?
That's such an awesome question right now, Tally, because honestly, that's very much what the environment that you're seeing, right? You're seeing the indexes be relatively flat. You're seeing, like the equal weighted Nasdaq has been rotating lower in the last month. So you're certainly seeing some weakness in certain broad indexes, but at the breadth level, the breadth is actually remarkably strong right about now, right?
Right. Yeah.
The bullish
Yeah.
percent index, which is a kind of a lesser known breadth indicator, is based on point and figure charts, which is a classic kind of old school
Oh,
charting
yeah.
methodology, but still pretty valuable for just tracking trends. It's pretty strong for the S&P 500, not nearly as strong for the Nasdaq 100 because you've seen a lot more of corrective moves there, but still pretty good for the S&P. We've got about 70% of the S&P 500 members above their 200-day moving average, about 70% above their 50-day. So most stocks in our benchmark are in a position of strength. And again, while the S&P has been flat, the advanced decline lines have been strong. So for me, when you have this situation where indexes are flat to down, but breadth remains strong, I think for me, that is a huge signal that there are opportunities out there. And so being thoughtful and intentional about what sort of exposure you have in the equity bucket, and again, leaning into the things that are, that are improving and leaning away from the things that are not. I think it's very easy to do better than a benchmark that's in a sort of sideways consolidation phase. Those strong breadth readings are pretty meaningful. So what would be the concern here is when breadth starts to turn negative. And I think that's one of the things that's saving this market right now. We've seen that just in the last week or so. You've seen days where like technology is the only sector that's down on the day and everything else is up, but like the S&P is essentially flat. And that shows you how big of a weight. It's like there's one sector on
Yeah.
one side of the seesaw and the other 10 are on the other side, and we're balancing out. So that's kind of the environment right now. One way that this could resolve, if Micron and SanDisk and other semiconductors get so painful that investors just start going full risk off, and instead of just rotating into Caterpillar or other industrials, they're rotating into like utilities and REITs and consumer staples, and they're just kind of getting as defensive as possible. And you're seeing things like gold start to look good again and actually serve a safe haven role. That's where I think this market could get very, very, very ugly very quickly. And I think breadth rotating lower would be a great sign that that's starting to happen, because that would indicate that people aren't just rotating away from semiconductors into other things. Now they're rotating out of equities and getting defensive. And we haven't seen those signs yet.
So it's interesting. We, as an investment committee, we were looking at some of these, implied correlation and realized correlation, and it is ridiculously low, really, really low. And so you mentioned this is great for active managers. I wholeheartedly agree. I mean, this is a strange environment where you've got some names that are just getting crushed, call it down 40, 50% or more. And then other names are up a few %1,000 and it's parabolic. And so like for us, we try to employ risk management. There's a multi-factor quant driven model that I run in a few different iterations that looks at the main 4 factors: quality, value, momentum, volatility. We add trend in there because we think trend is different enough in some cases than just momentum, just pure momentum. But yeah, there's a risk management overlay in there, and I just was wanting to get your thoughts on risk management, because a lot of people think technical analysis is just all about making money and high flying stocks, but there's a real risk management component to it that I think a lot of people just don't understand.
100%, Jim. And I would say that that's very true. And arguably, I mean, if you ask any seasoned investor, they would probably agree that buying is the easy part, right? Knowing when to sell is probably way more challenging. And honestly, because in some ways you have to let go of an idea and sort of, and sort of shift things around, which is never easy. So what's funny is I started learning about technical analysis. I knew nothing about investing in college. I studied music and psychology, Tally, to your comment earlier. So I knew nothing about anything related to the markets, but luckily started at a firm, Bloomberg, which would teach liberal arts majors like me how the markets work and how to do bond math and what the Fed does and all that kind of stuff. And so I was able to learn a lot from seasoned investors that were our clients, and I'm super thankful for that. But when I started in June of 2000, my introduction to technical analysis was watching many of our clients who had been absolutely crushing it in the late 90s get absolutely dismantled, and just everything that they thought they knew about investing was completely destroyed, and their firms and their funds were destroyed as well. And then I saw this other cohort of my clients who did remarkably well, and they were all technically oriented. They were ones that were looking at charts and just kind of very patiently saying, whatever was happening at that point is no longer true. And we're seeing these rotations and we're taking bets off. And they were laughed at as they're taking bets off, soon after the top, but then eventually very validated. And so for me, I actually learned technical analysis really as a risk management tool, and recognizing its value in showing you when a position that you had in your portfolio was no longer a good idea. And so a lot of the work that I do even today with advisors and with individual investors is, what's your process for regularly reviewing your holdings and recognizing when something that had been helping you is no longer helping you, and just having the courage to actually take action. I think that's the other problem, Jim. And again, one of my mentors, Ralph Acampora, to keep alluding to him, he would say, analyzing the chart's the easy part. Actually doing what the chart tells you is the tough part. So the challenge is, when the evidence shifts, is actually having the conviction to say, okay, I now need to rotate out of that position. And again, I was able to learn from investors who navigated kind of that early 2000s period very, very well. For me, I think my biggest challenge, to be honest with you, is just remaining bullish and not getting skeptical. And I used to laugh with one of my analysts at Fidelity, Mark Dibble, who started in the industry in 1982. He was he was always just kind of bullish because he learned about charting at a time when everything started to work. And I learned about charting when everything started not working. And so, that served me well in 2007 and 2008 when I saw clear signs of, yep, this is a major top. Here's how it looks. It did not serve me well in 2013 when the S&P made a new high and then just kept going. So, for me, those lessons along the way were a reminder to focus on the evidence. But for risk management, I think technical analysis is so incredibly valuable, and probably understated how its value there.
Let me change up the format a bit. So let's do a little debate here.
Oh boy.
I'll try and get under your skin a little bit. So valuations tell you what to buy, fundamentals tell you when to buy. Agree or disagree?
All right, Tally, you're gonna have trouble getting under my skin. I'm a pretty calm guy, but I appreciate the effort. I respect the effort. I mean, listen, I would disagree with the idea that valuations tell you what to buy, and I would argue that valuations are really good at one point in the cycle, right? When the market gets really beaten down, I think making the argument for valuations makes a ton of sense, right? And if you look at quantitative factor investing, there are two factors that consistently add value, even though it's now well documented and we've all seen it. It still works. And the one is value, which is buying generally companies trading below some valuation, and the other one's momentum, which is following trends and following strength. So I would argue the technicals tell you what to buy and when to buy, but I'm incredibly biased with my background and my experience. I think valuations do play a crucial role. I think investors get into trouble in growth-led bull markets when they cite valuations as a reason not to buy things. I think that's where you get into a lot of trouble. And we've seen that all the way up. You can argue that companies are overvalued, but in any great bull market in history, you could make that argument all along the way up. So I have learned following those trends much more valuable than being worried about overvalued conditions. We have a major correction. I would be 100% on board with thinking about the valuation argument for sure.
Yeah. I mean, the third, I guess, time-tested factor I would add, of course, is earnings estimate revisions. And I learned that from an old white paper from Rob Arnott back in the 1980s.
Yeah.
We had called the Monitor of Analyst Earnings Estimate Revisions. And that is all it did. And that's how I cut my teeth in the business back in 2000, actually. How about that?
Isn't that funny? No, and it's funny a lot. I think certainly for a lot of individual investors, the problem is in the financial media, there's way too much of a focus on what were the estimates and how did the company do. They focus on results. But any institutional investor who really focuses on earnings would tell you, I think what you and I have both experienced, Tally, which is it's all about estimate revisions and it's all about expectations and how they're changing. It's about forward-looking things down the road. And so I think the successful investors I've worked with have focused there. That's going to keep you on the right side of things and also help you understand when expectations are starting to shift, probably for good reason.
Yeah. So over the decades, and I want to ask you this question, but just talking how my approach evolved and changed, across time and experience. But nowadays I treat valuations more like risk metrics, kind of the way you were talking about risk management. When they're too high, should I be? And of course, there's the Maladovsky effect and, the cyclicality of the earnings and the sector under study. And there's all sorts of additional complications. But generally, I tend to be less dogmatic about the valuation factor than I was. But generally speaking, so fast forward 2026, how has your framework and process and basically evolved?
Ooh, that's a great question. So I would say that there are a number of things in the technical analysis toolkit that are sort of those tried and true approaches that are based on kind of foundational principles, right? And I would say the essence of trend following, right? The essence of following strength. The earliest paper I read on that was a white paper from the 1960s that talked about stock selection based on relative strength. Is by Levy. It still holds true. It resonates very much today, which is basically I'm going to look at a list of stocks and I'm going to order them based on their performance on different timeframes, and I'm going to use that as a way to evaluate where to be. So I think that is one of those continues to work, and arguably because human nature is still a primary component in what stocks are doing on any given day. What's changed for me, it's things like, volume, right? It's things related to market structure, right? So if you think about how stocks actually trade, like when I was starting, when you were getting started, Tally, it was, decimalization was still relatively new, right?
Yeah.
And so a lot of people are still thinking in eighths, and now we're kind of switching to a different way of, so we're talking about, what that would do. And obviously that's continued to change. Dark pools, just the, decentralization of trading. A lot of that has shifted. And so a lot of the volume-based indicators you read about that were designed in like the 60s and 70s were really derived from a time when the brokers get to the post on the floor of the exchange, and like that's where the trade happens. And so volume was a very sequential, thing because there was one kind of central place. Now you've got a bunch of trades going all over the place. I think volume means something very different because the options market has grown to the degree it has. Big volume doesn't necessarily mean a big institution is adding a bunch of, a big position. It could mean a couple hedge funds are just trading a bunch of, things related to an option strategy or offsetting some sort of risk. So, I think being thoughtful about which areas of the toolkit have remained valuable because of what they represent has served me well. And so for me, generally, it's things based on momentum that I think still very much make sense. Things based on behavior and recognizing that investors still get way too excited and way too panicked. And that still happens. And so for me, it's those two buckets that kind of define what I use. So things like volume and others that I think are more structural, I've abandoned those over time.
Interesting.
That's helpful.
I wanted to ask you about while we're still talking about investor behavior, the presence of AI and I'm using, and Talley knows this, I use AI for all kinds of different things. There are different models that we look at, and it's primarily research. But I wanted to ask you, with more people using AI tools, and I feel like that for the most part, these tools are rational and they're based on, quantitative data, right? So, but it's still not perfect for sure. Do we ever get to the point where people use these tools, or maybe they use other tools, they get more rational, the markets become more boring, more predictable? Or is it just human nature that there's always going to be speculators? There's always going to be people that are, the FOMO and greed and bubbles. I mean, I'm kind of thinking maybe the latter, but I wanted to get your thoughts on that. Does AI impact this at all, or does it exaggerate it?
I'm way more of a fan of AI after I heard the introduction that it put together at the beginning of the episode here, Jim. So that was good. I like that. Honestly, I use AI all the time for my own work. And the way that I've described it to people, it's kind of like having a junior analyst at a big firm like a Fidelity.
Yes.
I think we get into trouble when we treat it like some sort of market expert. It's like you give your intern a project and they come back. It's usually interesting, but it's often like completely wrong. And you have to go,
totally different.
No, that's not, like you went here and that is not where you need to go. So it has to be an iterative process. And I think the problem right now is probably over-reliance and an unrealistic expectation of what it's actually doing. It's doing mediocre work in a lot of times, and it's still valuable, but you have to, interns are valuable, but it's a process. It's not just a one and done kind of thing. So the way that I think about it, for me, I'm excited because it's going to make what I do easier. And I think that's good. When I think about the role of the technical analyst, 50 years ago, 60 years ago, 90% of your time was spent updating the charts, right? So back in the day in the Fidelity chart room, most of their time was like going to Barron's and then calculating the ratio and then drawing the chart with the pencils. And then the last 10%, you'd actually analyze what you'd done. And, for me, I learned technical analysis when it was all computerized. And I was sort of the first generation that didn't really know hand charting, although some of my mentors annoyingly made me do it to, for an educational value, which I learned plenty from it. So it was a good thing, but I hated it at the time. But I don't feel like I'm less capable as an analyst because I use charts that are generated by Bloomberg or by wherever we go to now. Like it made my role different. And instead of focusing on producing charts, I can focus on analyzing them. Now charting platforms are thoughtfully including AI, like, hey, create a chart with a 14-day RSI and color code the MACD indicator based on whether it's an up day or a down day. I don't know how to do that on a lot of charting platforms, and I really don't want to spend my time coding what the chart looks like, but I can tell an AI, here's what I'm looking for. So things like that, I think are great. For scanning, for idea generation, for, thinking about how what we're seeing right now relates to previous periods. I think that's awesome. At the end of the day, though, you still have to take that information and make a decision with it. And I would say, quantitative investing has certainly evolved in the last 20, 30 years. Is there still a place for people to be discretionary investors? I think there is. Even though quantitative investing has become pretty big, we still use those models, at least I would argue, use those models thoughtfully and think about, how do I want to structure a portfolio based on these different inputs? So, for me, I think AI is just the latest iteration of many things that I've been asked about over my career of how is that going to, torpedo the role of the financial strategist. I mean, it's going to make our roles change, and I don't mind that. Change is pretty good usually. So I mean, and for now, I think it's taking things that I didn't enjoy doing anyways and making that easier. So I have no problem with that.
Sure. But you think human nature is human nature, right? I mean, there's still going to be people that, speculate and markets, the pendulum is still going to swing too far to the one side or the other.
I would say the day when our advisor viewers say that their clients are not getting nervous and getting excited or getting way too euphoric or way too panicked, then we can worry about it. But the reality is that is the underpinning emotional state with which investors put their money to work. And I don't think that's changing.
Yeah, makes sense.
All right, Dave. So you've mentioned RSI, MACD, price, breadth, point and figure, candlestick. What is your favorite indicator, and what do you think is the most overrated?
Ooh, that's an awesome question. Most favorite indicator. I mean, so for me, relative strength is the most important, right? And so, and I would say at the stock level, relative strength. If you're investing in stocks and ETFs, relative strength is basically measuring how this chart or how this asset relates to all the other places I could put my capital at this moment. And I feel like investors get into trouble when they don't realize the importance there. I think that's something that institutional investors generally understand because you're paid based on your ability to outperform. So you are laser focused on making sure that you do so. Individual investors, I think, too often think in absolute terms, and they don't recognize the value of outperformance, particularly in bear markets. That's where it can really add value. So I think relative strength, certainly at the stock and ETF level, absolutely essential. At sort of the higher level, at the index level, measures of momentum, I think, are super helpful. And so RSI is the indicator, which is a horrible name. It's called the Relative Strength Index. It's really, I mean, it's I wish Wells Wilder, who created that indicator in the 1970s, I wish we could go back in time and change that, because it's really price action relative to its own history. And it's whether, it's sort of taking a Z-score for a data series, which if you've studied statistics, it's just a way of normalizing the movements and thinking about extremes, right? And when something's a little stronger or a little weaker than normal. And I think particularly for, longer term investors, recognizing the short term kind of tactical time frame and how that relates to the longer term time frame can get people out of their own way and help them not overreact to short term movements, because you recognize that that's part of a longer term trend. Yeah. So I would say, so I cheated and gave you two answers, but those would be my two.
What's the most overrated?
Oh, yeah. Sorry, you did mention that.
Yeah.
I mean, yeah, no, great
indicator
point.
Too. Like
yeah,
so
you
could beat up on that.
So I hate to answer that
too,
because someone in the technical analysis community probably is really into it, and I don't want to offend anyone. But for me, in my own experience, cycles are something that I've generally relied less on, and I will tell you why. Earlier in my career, I worked with a lot of hedge funds. I worked with a lot of trading floors. They loved repetitive cyclical patterns that they could bet on. They loved price swings and being able to bet on mean reversion on any time frame. That was something that they could make a lot of money with. But then I started working for a lot of long-term growth-oriented fund managers and their shareholders, and I realized that that if a position, I'll never forget going into a portfolio manager's office. This was soon after I had joined Fidelity. And the stock had this fantastic run. It was one of their biggest holdings. So I went into his office to say, hey, listen, it's hitting this cycle and we need to lighten up. And he almost laughed me out of his office. He's like, this is my best holding. I'm killing it. There's no way I'm touching this thing until it tells me that something's changing. And I realized for me, an over, sort of reliance on cycles would cause me to make changes despite market evidence that would be weighted the other way. So I still pay attention to, market seasonality. I mean, I'm still very aware that in a midterm election year, we're entering usually the seasonally weaker part of the year, and usually August into September is usually weaker than normal. But if the charts look really strong, I'm still going to want to follow the trend higher. So for me, I would say cycles, sometimes an over-reliance on cycles can get you into trouble because you ignore the market evidence. And for me, it's evidence first. And if a trend is strong, I've learned to stay with that as long as possible. And that goes back to the Peter Lynch, sort of approach that, if you sell your winners and hold your losers, you're pulling your flowers and watering your weeds. And we want to do the opposite, right? So if something's working, we want to water those and nurture those. We want to pull our weeds. That's how we grow a healthy garden. That's how we grow a healthy portfolio.
It resonates because I was at a multi-trillion-dollar asset manager for many years. It'll go unnamed on this episode, but they had a very cycle-dependent framework, and of course they were manufacturing indicators, and they were stuck in the wrong regime for several years. And I was allowed to, thankfully, because of our diversity of thought culture, to depart from the house view. And so our distribution guys had something to work with. But I've learned that lesson too. So thanks for your story, Dave.
Yeah, for sure. And to be honest, I think the way that you navigate, the way that you mitigate that, for me, it all comes down to routines, right? It's how you spend your time as an investor. So for me, I've developed daily routines and weekly routines and monthly routines. And I've developed those over my career as a way of recognizing that it's not about predicting the future. It's not about guessing what turn is going to happen tomorrow. It's just having a consistent process of recognizing the market conditions and seeing clear signs when they shift. And I feel like a lot of times for investors, the problem isn't that they are unable to predict that next move. It's just they're not seeing clear signs of a rotation. And that's where, again, we get into behavioral pitfalls like we discussed earlier.
Hey, what is your, we don't have a lot of time left here, but what is the very first chart that you look at when you go into your office every morning?
Oh, I love that question. So I have a morning coffee routine, which I share with my own clients, which is, you get your cup of coffee, you get all ready, you sit down, you fire up the laptop. What do you look at first? For me, it's a weekly chart of the S&P 500. And it's using what I call the market trend model, which is basically looking at 3 different time frames. So I use a series of exponential moving averages, which if you know the toolkit, that just means you're smoothing things a little differently, you're weighting the more recent data more effectively. And I think any good kind of trend following approach, exponential averages make a ton of sense. And so I basically define the trend on the weekly S&P chart on that long-term time frame, like over a year plus, the medium-term time frame, a couple months, and the short-term time frame, a couple days to a couple weeks. And so before I do anything else, I kind of anchor myself to, here's the big picture, here's the overall secular environment, here's that cyclical time frame, and here's where we've been the last month or two, here's the tactical time frame, and here's the last couple of days and how they fit into the big picture. I feel like too many investors start with the current market, financial media, their portfolio. And the problem, everything that I just mentioned is designed to sensationalize short-term movements. Yeah. So I was taught, make short-term decisions with short-term data, make long-term decisions with long-term data. So by starting with a weekly chart of the S&P every morning, I kind of anchor myself to, here's the picture. And now let me start going through a bunch of other evidence to see how that picture is maybe starting to evolve.
That makes a lot of sense. I will look at the elder impulse signal, which is kind of looks at weekly and tries to, I try to look at that, and then directional movement, if the trend is changing. But I 100% agree, zooming out, sometimes there's just so much noise if you look up too close. Dave, this has been fantastic. I love the discussion and your feedback. I don't have any other questions, Talley. I don't know if you have anything else, but we're super, super thrilled to have you join us.
It was awesome.
No, this is a pleasure, you guys. Talley, awesome to see you again. And
You too.
I hope it's not so long between our next interactions. And Jim, awesome to chat with you guys both. as
Yeah,
well.
you too.
Hers and his, three's company too. Come and dance on our floor. Take a step that is new.